You're checking out the Investor Shed podcast with Nick Beveridge and Jeremy Kitchen. They're on the path to financial freedom and they're taking their community with them. Stay tuned for the best free real estate investing advice on the internet.
Welcome to the Investor Shed podcast. My name is Nick Beveridge here with white shirt Jeremy. How you doing?
I'm doing so good. How's it going today, Nick?
Good. Sorry, I always comment on the color of your shirt.
That's okay. I always wear white apparently because you and I are like the yin and the yang. I bring the brightness. You are just a depressing.
Yeah, I'm just wearing a black shirt in a dark shed.
Right. I could close my eyes and I could have your dress attire on my calendar and I could bet Nick wears a black shirt and blue pants 6 out of the 7 days of the week.
I do have blue pants on. Look.
Called it. Nailed it.
All right. Today we have a freaking good show, don't we?
Yeah, today was really good. We got Mark Martinez. He's with Waterstone Mortgage. Mark Martinez has a lot of great info to share. He's a lot of cool tidbits, and he's always just coming from abundance. Like, he wants to help, and he wants to earn business the right way. And he's a solid dude to be in business with for sure, so...
Yeah, I'm just so impressed with just everything about him almost. The way he's able to like consistently run a successful lending business and he's able to share how he does that. He's very good with clients and very good at educating people about mortgages. One of the best I've ever seen. And I'm really glad he was able to take the time out and be able to help us with this podcast. And please stay tuned to the very end because Mark gives some predictions on what's going to go on in 2023, and he just called it. He didn't think that it was much of a prediction. He just said this is what's going to happen because of this data, and it's hard to argue with him. So, without further ado, stick around, grab a bowl of cereal, and listen. Everybody, welcome to the Investor Shed podcast. I'm here with my co-host Jeremy. How's it going?
Doing super well. How's it going, Nick?
Very good. It's been a great weekend.
Good.
Mark Martinez, our guest today. How are you today?
I'm doing great. Happy Monday to you. If anybody watches the recording, happy Tuesday, Wednesday, Thursday, Friday, or Saturday, or Sunday.
Or Sunday, yep.
I appreciate that. Yes. Thank you for taking time out of your busy Monday morning. This is probably the worst time to do a podcast, but anyway.
Yeah, Mondays are my go days usually, so it's all right. But you guys are important. You guys are some of my favorite people in the area, so for sure.
I appreciate that. Speaking of area, you just moved up here recently, right?
Yes, I moved up just over 2 years ago to Coeur d'Alene. I'm in Hayden, but literally across the street from Coeur d'Alene, the northern border. Am I allowed to say where I'm from, or would you prefer I not?
Absolutely.
Okay.
Yeah, no. Everybody knows that we talk about Idaho quite a bit. So.
Yeah, exactly. No, I'm a Southern California native, born and raised there. Grew up in SoCal. Went to college in San Diego, and then moved up from Mission Viejo. So I was a fourth generation Californian. My roots ran pretty deep there. And so to make a move up here to North Idaho was not a callous or flip decision. It was just something that we just felt that was ready and it was time for our family. So we moved up just over 2 years ago and we absolutely love it here. We're so glad we moved.
Gotcha. So what brought you from California? Like what gave you the idea to move to Coeur d'Alene, Idaho?
Well, thankfully, my sister had moved up here ahead of us. And so I had never been up here before. So we came up to visit her when her house was built and to visit. And my whole family fell in love with the place, except my 19-year-old daughter at the time. And so she did not want to move at all. But she decided to move after all, and she's so glad that we did. But we just felt the California that we grew up in was no longer the California that we left. We just felt that the values were quite a bit different, and they just weren't conducive to the things that were important to us. And we found that here in Idaho, and so what's interesting is that I'd always remembered people coming from other areas that had seasons and had 4 seasons that came to California and lived there. They would say how much they disliked the fact that there was no seasons in California. And I would say, sure there are. We have 2. We have warm and we have hot. So which one do you want? But now, having lived here, seen spring, summer, fall, and winter, I totally get it now. I absolutely get why people miss the seasons, and we have just loved it. And everybody here has just been so gracious and hospitable and friendly. We couldn't have asked for a better environment to live in now.
That's so true. So I grew up in Idaho. Like I spent the majority of my life here, and then in high school, I moved down to Florida with my mom. It kind of got to me. I didn't know exactly why. It just did not feel like home. But it does get kind of mundane when all year long you're dealing with, yeah, like you said, either hot or warm, and nothing really changes. You don't have a scenery around you. There's no mountains. It can get pretty monotonous, and I certainly, as much as I hate the snow sometimes, it sure is nice that every 2-3 months the weather's changing quite a bit.
And I'll add to that, you don't realize the melting pot that you were in until you leave it, and then you go back and visit, and you're like, oh my gosh, I lived in this, I put up with this. And so I'm not dissing on people that still live there in California and love California. Believe me, it's everybody has to choose for themselves. I always say nobody chooses where they were born or where they were raised, but we get to choose where we live once we become adults. And so choose wherever you want, and we choose here. So
awesome. So Mark, you are a one of the more top producing lenders in the area. And I want to ask you a little bit about your background first before we get into lending in general for investors. When did you first become a lender? What made you want to get into the industry?
So I first got into the industry in 2004. So as of this recording, it's been 18 years that I've been doing mortgage lending. I never went to college or ever grew up with any aspirations of becoming a mortgage lender. In fact, the first time I was asked if I would consider doing lending, my initial reaction was, ooh, why would I want to do that? I mean, and I don't know why I had this recoiled response to that, because in the homes that I bought and refinanced, I never really had a bad experience with the mortgage process, but I don't know why. It just seemed like it was on par with a used car salesman, and I don't know why I thought that. But the reason I got into it was, believe it or not, this will be interesting to some people, is I used to be a pastor. I was a pastor at a church. And so we went through a process where I stepped out of that role. And one of the guys that went to the church had said, hey, why don't you get into mortgage lending? And he says, I think you'd be great at it. And I said, well, why do you think I'd be great at it? He says, well, think about it. Number one, you have a really, really wide network. Number two, the network that you have, the people trust you because you've earned their trust. They've seen you at work. Number three, he says, you have a business and a sales background. Bottom line is, no matter what you do in lending, you still have to be able to sell. He says, number four, you have flexibility in hours. You can work the hours you want. You don't have to work the hours that you don't want. Your schedule's not controlled by anybody. He says, and then number five, you can still allocate your time first and foremost to the things that you love most, which is just helping people and ministering to people, and then still make a pretty decent living out of mortgage lending. So, and I'll show you how to do it. I'll mentor you into it. So I thought about it, prayed about it, and talked to my wife about it, of course. And so that's how I stepped into it back in 2004, and I've been doing it ever since.
All right. That's a pretty good intro to that.
You've probably never met a mortgage lender that was a pastor before, huh?
No.
They're usually the hellbound people that get into mortgage lending. I don't know. Are we going to have to edit that out? I don't know. If you have to edit
No,
it out,
not at all.
I'm just kidding. All my other mortgage compatriots. Sorry.
Well, people don't naturally just... I mean, it's just like a realtor. Every realtor has a way different background. And I feel like most lenders... they also have very different backgrounds. We're just people, so I don't think you have to generalize too much.
Yeah.
All right. So we got your background. Tell us a little bit about. Hey, have you worked much with investors getting loans on rental properties?
Yeah, so really my true start with investors in terms of on a regular process is since I moved up here and got involved with you guys, with the North Idaho REI team. Now, throughout my career, I'd done a number of different loans for people that bought investment properties. But those are people that kind of on their own determined, hey, I want to buy this home, and yeah, I need a loan, and that was it. But the experience with the REI team, which I think I've been connected with you guys for almost 2 years, definitely at least a year and a half, almost 2 years or so, and just seeing the intent and the focus and and being deliberate in how you help people usher them through becoming investors is really my first experience with it. And I'll tell you, I'm like super impressed at the hospitality and the charity and the willingness to share with everybody that you guys do. I mean, usually people, whenever they do the things that you guys do, they're expecting something in return, a handout, they're charging a fee, they're charging a membership, come to our conference and you pay this, that, or the other. You guys show up and do it for free, and any questions you have, people ask. And so what typically happens is, the whole concept of givers gain. If you give to other people, you're going to gain as a byproduct. And I think you guys probably see at least a snippet of that, if not maybe even more, is that because you guys give so much information and helping people understand, wholesaling, flips, seller carrybacks, creative private money financing, negotiating deals. I mean, all the tangible things that you bring to the table, both through your podcast, through your meetings, and just through one-on-one consultations you do. It's just I haven't seen that in other environments. Everybody else that does the kind of things that you guys do, they charge for it. And you guys do it because you love it and because you want to help people. And then when people recognize that, they want to use you for their transactions, and they should. So yeah, that's been my experience with real estate investing.
Well, I appreciate that. I feel like that was one big pitch for us, but
oh yeah, no charge on that one. That one's free.
Right, we appreciate that.
No, I appreciate that. I just have this firm belief, or at least I convinced myself a long time ago, that I had a choice because there were other people in the region that were charging for these types of events, or they made it all about, there was some sort of thing that they were going to pitch a couple weeks in, some mentorship program or something like that. But I honestly just believe that if you give enough value to a group of people, real actual needed value, and they keep coming back, eventually they just can't help themselves but try to figure out how to pay it back. And how they can pay it back is just use our services. I mean, it's real simple. And we barely have to ask for the business. People just naturally get a hold of us when they're ready. It took a long time to build up. It took a long time to get a solid group of investor clients. But I just believe in karma. You get what you put out there. And I had a choice. I can try to collect money up front for these events, or I can collect people's businesses over time, and it's worked out that way. So appreciate that.
Yeah, and when you think about it, anytime you're trying to build something, you got a lot of hard, dry ground that you got to turn that soil, and you got to remove the rock, and you've got to water it, and you got to fertilize it. Then you seed, and then you weed, and you do a lot of stuff, and it's a lot of work that you have to be consistent at. That if you give up midway, you'll never harvest a crop ever. And so what I see you guys do is you've done all the hard work, that heavy lifting. And so now you guys have a crop that you're able to harvest. And some people, that's just the nature of humanity. Some people will always be takers, and that's it. But other people they're gonna take, they're gonna learn, and they're gonna value, and then as a result of what they value they're receiving, they're gonna reward you in return for bringing that value to the table. So kudos to you guys. I'm really, really happy to be part of this.
Yeah, I appreciate that. And just one more comment on that. Some people are going to be takers, and you just got to be comfortable with that. Like your statistics, that every person that you speak to, you're not going to get a deal out of. And I think you said at one point only 13% of people that actually go through the application process with you end up getting a loan anyway. That's just kind of a national average, right, Mark?
Close. About 13% of all people that are leads, somebody who wants to have a conversation about a loan, actually turn into transactions. So about 50% of leads turn into an application. 50% of those applications turn into approvals, and then those approvals, a total of about 13%. Not of the approvals, but 13% of the leads actually turn into transactions. So you got to filter through a lot. It's just it's your batting averages, right? So that's why you just have to have a lot of conversations. That's the number one indicator of success. This is maybe for people who are out watching. In any sales organization, the number one indicator of success is how many conversations do you have per day on what you do. The more conversations you have, the more that you talk to people about the things that you do, the higher probability you're going to have of having more transactions. That's the bottom line. So
And I just think it's so awesome that you're very aware of those numbers. So for any lenders, realtors out there that are listening to this and they're struggling, they just got to figure out what those numbers are and have faith in them, and then just have those conversations on a daily basis and keep track of it, right?
Yeah. I used to think it's kind of funny because I used to think before I started tracking my numbers, I used to think that half of all the leads I got turned into deals. And then I actually started tracking the numbers. I'm like, oh, I guess not. So
Not quite.
It's way worse.
yeah, so it is amazing. It's amazing. You know, I have this something called an activity tracker here where I track my activities and stuff, and it's amazing when you track your activities, what the numbers will show. And that's part of one of the things I love doing about mortgages is, like I say, it's all about the numbers. They either work or they don't. For me, there's no emotion tied to my portion of the transaction. There's a lot of emotion tied to the home purchase part and the real estate part. You know, do I like it? Location, features. Do I like the seller? Do I like the buyer? I mean, there's a lot of emotion tied to that. And for me, it comes down to two things. Do you have the money that you need in order to purchase the home? And are you comfortable with the monthly payment? Those are the two factors that anybody's going to look at that's going to buy a house, whether it's for a personal property, a second home, or investment property. How much is it going to cost me to close? And what's my monthly payment? And if you're comfortable on those two, go. It's a green light. You should not delay. No yellow lights, go. But until you get those two green lights, and that's when you got to work with somebody to help you put together a game plan, a blueprint, so to speak, on how to get to that point where both those lights can turn green. That's part of what I do. That's part of what I love doing is I love outlining game plans for people. I've had people come to me where over my career who are like, I know you want to, but not today, and here's why. But if you do these things, then I'll get you there. And I've had people where the game plans were as short as 3 months and they did what I told them to do and we got them a home. I had other people where the blueprint, the game plan was as long as 3 years and they did what I told them to do and we got them a home. But here's what happens. The majority of the people take that game plan and they never come back because they just don't have the discipline. They don't have the internal fortitude. They don't have the drive. They don't have the commitment to themselves to change the things that they were doing that got them to where they're at in order to get them to where they need to be to purchase a home. And so that takes discipline. Some people have to cut back on spending. Some people have to get a second job. Some people have to work on their credit. Some people have to deal with things that they just didn't want to bother with. Well, if you can't get into a home because of those things, there's only one way you're going to do it. You've got to change what you've been doing. Some people are willing and driven to do it and some people aren't. So that's where part of the numbers and the averages come in.
Yeah. Yeah. So since you have been tracking your numbers and you've been in this a couple of decades now, do you have a rough idea about what your average is from the first time you have a conversation with somebody until you've actually closed a deal with that person, if you ever do close a deal with that person?
You mean average in terms of timeline?
Yeah. Yeah, because I remember about 5 years into the business, after me tracking my numbers, I was able to go back on all my closings and then go back and check my database on my clients. And I found my average was almost 18 months from when I had a conversation with somebody until we actually closed a transaction.
Wow.
And it was pretty eye-opening at the time. I was like, holy crap. I mean, you do get those clients that, they'll call you and then we'll write up a contract and, 2 days later. But that's not an average. And I'm just curious if you ever look back at anything like that and found how long it typically takes to have a conversation with somebody until you do a deal.
I haven't tracked those specific numbers, but I will tell you, I would say typically from the time somebody comes to me and we get them into a home or a loan, or at least get them approving into a home, it's typically within about 90 days to maybe 120 days. It's definitely not 18 months because most people when they come to me, they want to buy a home. They want to get approved. But remember, what is a prospect? A prospect is somebody who is ready, they're willing, and they're able. They're ready to buy something. They're willing to do what it takes to get it, and they have the ability to be able to do it because their finances are in order. Some people are ready and willing, but they're just not able. Some people are able, but they're just not ready. And so all three of those have to be in place. And so I would say that most people that come to me are ready, And as long as they're willing and able to do the work, we're usually within 90 days from the time I had my first consultation, walk them through the process, get them approved. They go out home shopping. They find a house. They submit offers. They get accepted. We open up escrow, and then your typical 30-day escrow. I would say usually most of that timeline is within 90 to 120 days. The longest one I've ever had was 4.5 years. I have an amazing CRM where once I get a name and a phone number or a name and an email address, I never lose track of them until they either buy, they die, or they file a restraining order. So far, nobody's filed a restraining order, but I do. Yeah, I just do my callbacks. I'll circle back around with people. Based upon our last conversation, or I'll circle back up around with somebody for 6 months later, or they said, "Oh, we just decided to re-sign a lease, and we're in another year, so we'll call back. I'll call back in 9 months." And I'll have my notes, and I'll talk to them about our last conversation. They'll say, "I can't believe you remembered me." Well, as a matter of fact, we are ready to blah blah blah. And so we get them going. And then what's beautiful about that, I think, is that it allows me to contact the referral source and said, "Hey, do you remember so and so that we talked about a year ago?" "No, I don't remember them." "Oh yeah, they were this. "Oh yeah, I remember them." "Well, guess what? I just got off the phone with them. They're ready to buy. They follow my plan, and so I want to get you reconnected with them." And they're like, "Oh, cool." So it's like bringing deals back to the people who were my referral sources. And so yeah, that's the key thing, is that my longest one is over 4 years and people are stunned. My shortest one, believe it or not, was 42 days. I met with this one couple one time where they're like, "Hey, my sister-in-law, she's a realtor, and she keeps saying that we should be buying a house, and we're in our 60s and we've never owned a house. We've always rented." And I said, "Well, let's take a look." So my very first consultation with them, I went to their home, we ran the numbers. I said, "You can qualify for this much." "Really?" I'm shocked, And so I got them approved like literally the very next day. And then the day after that, they found a house, it got accepted, they opened up escrow. And literally from the first time I had a very first conversation to the time we were in escrow, it was within 4 days. And they were like, "Whoa!" They were like the white knuckle ride on the roller coaster. And he actually called me like 2 weeks or so into it. And he's like, "Mark, I got to be honest. This is like all moving so fast. I'm not sure if it's the right thing, if I'm doing the right thing." And I said, "Hey, listen," I said, "you're in your 60s. You've never bought a house before. Guess what? You're out of your comfort zone. Very normal. Nothing wrong with what you're thinking and what you're feeling. But be of good cheer. The day is going to come where it's going to close. The house is going to close. You're going to move in. I'm going to say, congratulations, your loan has funded. The house is yours. And your whole life and your wife's life is going to change." I said, "Is it possible?" I said, "Is it possible that the reason this has been moving so fast is that maybe you're just being super blessed right now? Maybe there's a reason why, and that the doors are wide open and there's no reason you should walk through those doors." I said, "Just keep doing each step that we have outlined for you, both on the realtor side and on the lending side. Just take each step. If you're not supposed to go down here, I'm telling you, a firewall will go up and we won't be able to work through that. Then that's your sign. But if not, keep taking that step until or unless we get to the point where the loan is closed, the house is yours, here are your keys. And then we'll have the conversation." So he did. He continued to walk in faith despite, his not uncertainty, but again, when you're outside of your comfort zone, something that was had a little bit of trepidation. And he got in the house and he was like, "Oh my gosh, thank you so much. I'm so glad." It changes people's psyche, and it changes their mind, and it changes the way they feel about themselves when they're a homeowner versus when they're a renter. It's a totally and not to mention all the other financial aspects of it, but it really changes how people feel about themselves. And so that's why I love what I do, and I think that's why you guys love what you do, is because not only do you help people become homeowners, but you help them become investors so that they can sever their W-2 dependent job with somebody else and live the life that they want to live. And they've set themselves up with the cash flow so they don't have to be concerned about their financial well-being.
That's so good. Mark, that was a really good answer to that question, by the way. I want to circle back just a little bit to your CRM and what metrics you actually track. As a newer lender, I know we do different lending. Obviously, I do hard money lending. You do conventional home mortgage lending. But just curious, what numbers are you tracking and what are you looking for when you're looking for your metrics?
So what we do is we have different categories that when we create a contact and we generate a lead in their CRM, we have categories. So the very first category is lead, and the lead just simply means here's somebody that new came in and they have to be contacted. Once we have a conversation with them, they can go any different ways. They can either go to the next column, which is called incubator. They're not quite ready. Something needs to happen. They need to do some things in there. So we move them to that column with a task. And that task is where I schedule what is that follow-up task? Is it a phone call? Is it an email? Is it a text message? Is it some sort of other communication? When do I schedule it? And what is that conversation? So I record it right then so it's fresh. So what happens is when the day comes up, when that task is due, it pops up. These are your activities that you need to do today. You need to call this person, text that one, email this one, and this is what you're supposed to do. And so I know each day what I'm supposed to do based upon what I'd scheduled already in the past. And so then if they're not an incubator because they're ready to move forward, then the next column is application. So when they're ready to submit an application, they move in the application column. Again, tasks are assigned. It automatically gives my team members assignments on who needs to do what based upon when the application comes in. Once the application comes in, then it goes into what's called a pre-approval column. So that's where the app is in and we've already pre-approved them. Then what we do is we also have something called a PCA, Platinum Credit Approval. Platinum Credit Approval is something that we do, not all companies do. In fact, I think most don't. But what a Platinum Credit Approval does is it allows the underwriter to see the application and do the approval. In lending, the underwriter is the ultimate decision maker. The underwriter can say no when everybody else says yes, and the underwriter can say yes when everybody else says no. So it always comes down to what does the underwriter say? Not what the loan officer, not what the DU says, not what anybody else says, but what does the underwriter say? And so we offer that as an option on most of our loans to get what's called the PCA, Platinum Credit Approval, which means the underwriter has accepted the file and approved it. So then that allows us to equip the realtor to go out with this Platinum Credit Approval and submit an offer that says, hey, listen, there's only 3 things we need on this offer. We need you to accept it. We need an appraisal at value. We need clear title. We're ready to go to the closing table. That's all we need. We've already been underwritten. The verifications of employment already been done. The credit's already been run. We've already verified assets. We've already verified everything. There's nothing else that needs to be done. We just need an approved contract. We need an appraisal showing value, and we need clear title. And if so, we can go to the closing table. And so we want you to accept our offer. This is what we coach our realtors on. We want you to accept our offer because this offer has the highest likelihood of closing and closing fast. So when you equip our realtors and our referral partners with that, it really helps set them apart from all other offers that might require a loan that hasn't been underwritten already. And so it's not uncommon for us to do and fund our loans in the 20s days. And when I say 20s, 21, 22, 25, 27, under 30 days. The fastest we've ever done was 9 days. 9 days, everybody's like pedaling really, really fast. So don't set yourself up for a 9-day close. But then anyways, after the PCA column is then, once we move them from there, then it's contract. When we're in contract with somebody, that's our next column we move them into. And then after contract is then when we move them into closing or the funding. So every step of the way, I have the ability, our CRM, to be able to dictate what's the next step, and it automatically triggers different team members on my team to do their tasks, and we can always see who's doing everything. So what it really does is it eliminates the communication confusion, the communication disconnect. As you and I know, every real estate transaction has multiple people touching the transaction. And so you forget, did you do my checklist? Did you communicate that? What did the customer say? I don't ever have to worry about what the customer said to one of my team members. I can go to the CRM in their file and I have the complete log, emails, phone calls, text messages.
Perfect. Okay, so being a lender, what would you say are like your three best sources of business?
Well, certainly, of course, realtors, number one. The reason why is people tend to go home shopping before they go loan shopping. And so people will say, hey, I want to buy a house. And I have a friend who's a realtor. Everybody's real fast to say, I have a friend, right? I know somebody. So everybody knows somebody who's a realtor, and everybody knows probably 10 people who are realtors. And so they'll typically go to the realtor, they'll call the realtor, they'll connect with them, and you've got you have your excellent realtors, you got your good realtors, you have your average realtors, and you have your really, really awful realtors. So your really awful ones are going to right away put them in their car and show them around properties. Your excellent and good ones are going to say, how are you going to buy your house? Cash or credit? There's two ways to buy a house, cash or credit. If they need credit, they need me or somebody like me, And so typically the realtors say, do you have anybody that's going to help you with the loan? No, I don't. Well, let me introduce you to Mark or whoever their referral person is. I'll have them give you a call. So that's why that typically happens. People home shop before they loan shop. So that's why the number one source is realtors.
Before we get to number two, can you expand a little bit about if other newer lenders were listening to this, how much time should they be prospecting or trying to network with realtors?
So if newer lenders are listening to this, zero. They should not spend any time prospecting. They should just sit at home, watch TV all day long, and do nothing so that I can go out and get the business.
That's a great anstor. Love it.
Is that what you want?
In fact, just refer them to Mark. It's just going to be easier that way.
Just refer them to me. Yeah, I'll teach you that. None.
There could be, lenders outside the area, not competing against you. How important would you say lead source number one is as opposed to the other two?
Of course, that was a tongue-in-cheek joke, of course. I wanted to give you an honest answer. But if you're new to the business, you should probably be planning on doing sales-related prospecting activities, minimum 2 hours up to about 4 hours a day. 4 hours is a long day, and that's really, really tiring, making calls and prospecting on people. And so what I typically do is if I'm making calls and on the phone and I'm prospecting, I'll work for about 50 minutes. I'll take a 10-minute break. I'll work another 50 minutes. I'll take another 10-minute break, And so you have to pace it out because otherwise you just burn out. You can't expect to throw it all in one day and then boom, your whole week is done. So then as you develop your realtor referral partners, you're going to find like any industry, you've got performers and you've got non-performers. So you want to minimize your non-performers and oftentimes time will tell, but certainly there are resources out there. I have a resource out there where I can look up any realtor and see exactly what their production is. I can tell exactly how many listings they've done, how many buyer sides they've done, what their volume is. I can find out which lenders they use. Now that might sound creepy, but this is all public domain. I should say public domain. This is all stuff that's recorded and has access to. So it's not like I'm, FBI Secret Service,
Yeah, you're working smart, not hard.
I have access to the tools is the bottom line, is I have access to the tools to find out, so you should talk to this realtor. They'll be really great. Okay, great. I'll look them up and I'll see what their production is first. And I'll always meet with them if I'm going to have a conversation with them. But if they're not a high producer, I'll remain in contact with them. I have a certain process I'll go through to kind of remain, visible to them because gosh, if they get 1 or 2 deals a year, that's 1 or 2 paychecks a year I wouldn't have got otherwise if I just dismissed them. But then other realtors who are your higher producers, then those are the ones that require more investment. So you'll source that out after a period of time, and then the higher producing realtors. If you can build to the point where you're at about 10 or 12 of those, that's really your sweet spot. I think people are misled to think that they can get 30, 40, 50, 60 high producing realtors that are referring them business on a regular basis. Maybe it happens. I've been in this industry 18 years. I don't know people that have that level, but most people are going to have 10 to 12 we refer to as whales. They're the big fish that you want to catch, so to speak. And so 10 to 12, and you manage those well, you can make a really, really good living off of that.
Perfect. All right. So what's number two?
A second is financial advisors, financial planners, financial advisors, because they're oftentimes, of course, advising people on, you're making this much money and you're a renter, you got to buy a house. So that's kind of an easy one. Financial planners and financial advisors is a second source. With them, you kind of have to you have to feed them stuff that's geared for the stuff that they like. What are the markets trending? What are the indexes looking like? Financial strategies for a financial advisor. So that's the kind of stuff that they like to be fed in terms of information. So that's, I would say, the second. There's the second group of referral partners. There's probably two more, I would say, if you're ready for them. Unless you want to ask a question on that one.
No, yeah, I wouldn't have thought financial advisor would be your second source. Maybe it's just me, maybe because I never speak to him.
So do you want me to tell you why?
Yeah, please.
So what a financial advisor does is they are in a position to look holistically at where somebody's income is, where their assets are, and where their expenses are. And their goal is to maximize their return and to minimize their expenses. And they minimize their expenses primarily like in areas of taxation. They're not going to tell them, hey, don't go out and eat tonight, or don't go out to the movies or whatever. They're not going to tell them those things. But just, the expenses and the write-offs. And so a lot of people who are renters are typically in a comfort zone of renting, and they don't realize what can be lost in terms of their financial portfolio by being a renter as opposed to a homeowner. And so an advisor will advise them of that. Hey, you want to limit your taxation? Buy a house. I'll give you an example. Here's my personal example, and I tell this to first-time home buyers. When I bought my first house back in 1990, I just aged myself. It doesn't matter. I don't care. When I bought my first house back in 1990, before either of you two guys were probably even born, I don't know, maybe.
Late 80s.
Okay, there you go. I wasn't married, single guy, and so I bought my first house, and I worked for this company, and every year I would file my W-4. The W-4 is who you file with your employer that says how many withholdings do you want to do, because all it does is tell them how much tax to deduct, both federal and state income tax. And so I always disclose zero, no withholdings on my W-4. And then when I'd file my tax return, I'd file one dependent, which was just me. And so every year I would get about a $3,000, $3,500 tax return. And that was my vacation money. It was like a forced savings. I didn't realize I was loaning the government my money, interest-free to them, just to get it back at the end of the year. But that's kind of how I set it up back then. I didn't know as much about money. Then I bought a house. Went back to my CPA the following year, gave them all my stuff. Here's my mortgage. Here's my 1099 that shows what or 1098, I guess it is. I forget what form it is for your mortgage interest and taxation and your closing costs and all that other stuff. He computes my tax returns and he says, okay, this year your return is $16,000. I'm like, what are you talking about? And they said, you've got a $16,000 return. I said, that's impossible. I earned about the same amount of money last year as I did the year before. I only got $3,500 back. And he says, but you're a homeowner. And I'm like, so? He says, when you're a homeowner, it's good. It's good for the economy because a lot of business and a lot of stuff revolves around home ownership. Not only all the people that are involved in the transaction, but homeowners tend to go to Home Depot and do improvements and paint and fix up and garden and all this other stuff. Homeownership is really, really good for our economy. So the government knows that, and they give incentives. And the incentives they give you is you can write off all your interest that you paid. You can write off your property taxes, and if you've paid any points, you can write that off. So it's deductions in what your taxable income is. So because you had all these deductions this year that you didn't have the year before, guess what? Your taxable income was lower. And because your taxable income was lower, you wound up overpaying throughout the year because you declared only zero on your W-4. That's why you got a $16,000 tax return. And I said, well, what do? He says, increase your withholdings on your W-4. To how many? He said, 5. And I said, 5? I'm not even married. I don't have any kids. He says, it doesn't matter. All the W-4 does is tells your employer how much tax to withhold. So based on 5 withholdings, based upon what your interest rate is and what you're paying, etc. If you show 5 with dependents on your W-4, when we file at the end of the year, you're going to have a net 0. You're not going to owe anything, and you're going to get nothing back, and you'll have more take-home pay. And that was a big, big lesson that I learned.
That's awesome. That's actually a really good story. Thanks for telling that. Another thing, just to expand on that, I remember seeing a long time ago a stat as a realtor sent by Keller Williams, and they just said, hey, by the way, nationally in the U.S., the average renter has a net worth somewhere around $5,600. Net worth, if they sold everything they had, that's about how much money they would have. And this was before all this crazy appreciation, but they said the average homeowner has about, and it was somewhere in the 40,000 net worth. If they sold everything they have, that's about how much money they would have. And I know these days, interest rates are higher, but the interest rates aren't as high as leasing. Leasing is 100% interest. So what would you rather have? Would you rather be saving up for a house, paying 7%, which you could probably get lowered some other day, or would you rather just continue to pay 100% interest and just be stuck? So.
Yeah, and you know what? To summarize, I always say this: whether you rent or whether you own, you're still buying a home.
Mm-hmm.
You're buying a house. You're just not buying your house. You're buying your landlord's house for them. And so the reason I was looking at my screen over here is I had some notes on this other screen. Last week I hosted our company hosted a webinar from an industry expert in our industry that talked about where we've been historically, where we're at today, and what the forecast looks like for 2023. And he talked about net worth in terms of renters and homeowners. And one of the things he mentioned is that the top 1% of people that have the highest net worth have a net worth of $10.8 million. Top 2% is $2.5 million. Top 5%, $1 million. Top 10%, $800,000. Top 50%, $500,000. Out of that net worth, 2/3 of that comes from home equity. 2/3 of that net worth comes from home equity. And so you're absolutely right. I mean, the charts that we have and the charts that we produce showed a renter versus a homeowner and the difference in net worth, not just over time, but in the short window, the very, very short immediate window. And the takeaway on this is, this is the takeaway on the summary and the takeaway in this aspect of on the webinar. If you plan to purchase a house and then sell it within about 18 months, yeah, you probably should stay renting. Because of the acquisition costs, the cost of closing costs, what you have to pay for disposal, and all this other stuff like that. Once you're over 18 months of staying in that house, you are way better financially to have bought a house rather than own a home. Rather than renting, is what I mean. So,
yeah, if you're playing the long game, it's hard to lose in real estate. Period. Whether you're buying rentals or buying your own personal house, as long as you're not planning on reselling immediately, I firmly believe you're going to be way ahead long term, because it's a forced savings account, and either you're paying it or a tenant is.
Again, looking over here at my notes, I'm going to add to that real numbers. Historical appreciation, the home appreciation historically average over the last 63 years. You want to know what it is year over year? Historically, over the last 63 years, 4.75% average appreciation year over the last 63 years. You know what the average increase is on rents per year? 8%. 8% rents go up on average 8%. So which is better? Having a higher rental housing cost by 8% every year because you're a renter, or earning 4.75% in value over the home you bought? And keep in mind, and this is real critical, that 4.75 is based on the value of the home, not how much money you put into it. If you put in 10% down payment, if you put in whatever the down payment is, you're earning appreciation on the full 100%. So it actually accelerates the actual return, your cash on cash return on the money you actually put in. And there are still loan programs out there where you can purchase a home for nothing down, zero down. We still have programs out there that are available. So if you're renting buy a house as long as A, you're comfortable with the first green light, how much money do I need to close? And B, you're comfortable with the second green light, how much is my monthly payment? Once you hit those two, and believe me, the first time you buy a house, those two numbers are going to feel like a stretch. But if you can make it work, it gets easier in year number 2, year number 3, year number 4, and it gets easier and easier and easier as time goes on. So that's my comment to renters.
And it's funny you mentioned, sometimes you can get down with this little zero into a property, and it's very hard to get into a rental property with zero.
Yeah, true.
It's hard to get in without $5,000, honestly. Like, I mean, you need your first month rent, last month rent, pet deposit, security deposit. Like, that's $6,000 right there.
So let's move on to that third source, if you don't mind.
Yep. So the third source are CPAs, accountants, because they're also looking at people's finances as well. And so they'll oftentimes give advice to people on, hey, you need to buy a house, So they're a good referral source as well.
All right, cool. And you mentioned just a little bit ago that you could get into a house with zero down. Do you mind expanding a little bit about what kind of loan programs there are out there for the people that don't know how they can get into a house with low or no money down without having to do seller financing or sub to or any of those extra creative things? But how could they just use a lender like you to get in with zero down?
Sure. So your zero down loan programs are going to be if it's your primary residence. You don't have zero down for second home or investment properties. You have to have skin in the game for those. Why? Because those tend to have higher rates of default. If somebody owns 3 or more properties and they run into financial hardship, they're going to default on their second home or their investment property before they ever default on their primary residence, where they go home every night and lay their head to rest. And so that's why a zero down payment program is available for people who on their primary residence. And there are multiple zero down programs. And the reason there's multiple is because some of the down payment assistance programs, that's what they're called, down payment assistance programs. DPA is oftentimes what they're referred to. Actually, the term is interchangeable. DPA and DAP, those terms are interchangeable for down payment assistance. And so, most of them are determined by the state. So every state has their own program, and even some counties will have their own programs or programs that can help homeowners as well. So it's important that whoever you work with understands whatever the state programs are if you need down payment assistance, because they can help. Usually on the down payment assistance programs where you have 100% financing, your window of what you have to meet to qualify is a fairly narrow window. And what I mean by that is that you have to earn enough money to be able to make the housing payment, but you can't earn too much to the point where they say, you don't really need assistance, you should just save more. And so there's kind of a somewhat of a narrow window on that. The exceptions are on what are called USDA loans, which are in homes in rural areas, a little bit less developed communities, as well as VA loans. Anybody who's a military veteran, doesn't matter how much you make, you can get 100% financing, and that is, I think, one of the best benefits that we can offer our the men and women who have served our country. So those are the down payment assistance. But there's kind of a somewhat narrow window of qualifying, and then of course USDA and VA. The best thing, of course, is if somebody has some money to bring into the game, that's the best thing. If you can bring in at least 3%, 3.5%, then the qualifying factors, the window expands in terms of how many more people will fit if you can get 3 or 3.5% down. Now, can I take just a moment to talk about where you can come up with down payment? Okay. So of course, one is money that you have, assets that you have, money that you have in savings accounts or checking accounts or CDs or whatever. Other sources of down payment, other source of down payment that's allowable in a home loan is gift funds from a family member. So maybe you have a family member, whether it's a parent, it's a sibling, it could even be a child if it's an adult child, it can be a grandparent, it can be an uncle, an aunt, anybody who is like a blood family relative can offer money as gift funds, and that's allowable. Another great source of gift funds on a primary residence is if you work for an employer that has a 401k, or if you have an IRA somewhere, Many of those will allow you to be able to use those funds without penalty. In other words, if you withdraw those funds and you're not of retirement age, you can use those to purchase a home, a primary residence, and not pay a penalty. If the money you use was tax deferred, in other words, the money went into that account without paying tax, when you take it out to purchase a home, yes, you will have to pay tax on the disbursement, but you're moving it over into real estate. And that's the key thing I want people to understand is I've had this conversations numerous times with people where they're saying, "Oh, but I don't want to spend my retirement account. I don't want to spend my retirement account on a house. That's for my future." You're not spending your retirement account. All you're doing is you're reallocating your retirement account. Your retirement account can be invested in a number of different funds that your employer offers. In this case, you're just moving it over from here to real estate. You're not losing it. You're just repositioning it. But here's the value of that. If you have $100 invested in your retirement account, and let's just say you earn 5% on it, you're going to get $100. You're going to get 5% on $100. If you put that $100 over here and purchase a house, and that house is worth $1,000. Of course, I'm using small figures, but you only put 100 in. Then guess what? You're getting a return on the $1,000, not on the $100. And so your gain, which is kind of what we already talked about earlier, is way, way greater if you reallocate first your monies into a home. So a lot of people don't realize they can use their retirement monies as a down payment. And then a final place that you can get access to down payment, not many big people do this, but some places may have access to this, is a church or another charitable nonprofit can actually be a source for down payment funds that's allowable.
What about realtors' commissions? Could they use, like if a realtor's buying a house, could they use their commission as part of their down payment, or could that only go to closing costs?
That can only go to closing costs, not towards down payment.
Gotcha. Now, what if could a realtor give somebody funds out of their commission to help with their down payment, or is that not allowed either?
No, that's not allowed either. And no, what the realtor can do is, again, if the realtor is a family member, then the realtor can front monies as a gift fund or as gift. So let's just say a realtor is going to make $5,000 or whatever in commissions, or let's say $10,000. They're going to make $10,000. Mm-hmm. If the realtor has $10,000 and they're related to the buyer, they can gift them $10,000 of their own existing funds as part of the down payment, knowing that they're going to get that $10,000 back in their commissions. So that is doable, but it has to be a separate thing.
The money's got to come before the closing.
Sure.
Because it's got to be sourced and verified, right?
Correct.
Before you can close. And the commission only comes once the closing is done. It's like the last thing to be paid. Mm-hmm. Okay, cool. So can you talk to us a little bit about investor loans?
Sure. So there's a number of different type of investor loans. Of course, you guys do private money investor loans. Your private money investor loans are typically going to be they're going to be more expensive than a conventional loan. And when I say more expensive, they're typically going to charge usually at least 2 points or 2% of the loan amount as an upfront charge. It can be anywhere from 2 to 5 points. I mean, there's no rules or guidelines. It all depends upon the size of the loan as well. So you're going to pay definitely points up front, and you're typically going to be paying a higher interest rate. Based on today's recording and the time that we're in today, you're going to probably be double-digit percentages. I mean, I'm just giving a generality. You can find something a little bit more, a little bit less, but it all depends upon where you find it and what the terms of the deal are. Always keep in mind that the higher the risk, the higher the cost. So if you're coming to the table looking for a private money loan and your credit's not that great, and you've got your work history isn't that great, and maybe your assets aren't that great or whatever, you're going to pay more. You're going to pay more for that. So the best thing to do is get yourself in the best position possible whenever you need to borrow money, and that includes best credit scores possible, best income stream possible in terms of stability, and the most assets possible that you might be able to have access to or be able to show. So that's, of course, that's one source. We don't do private money loans. You guys do, and you guys have sources to do that. So that's one way. Other types of investor loans, which are just your conventional loans, your Fannie Mae, your Freddie Mac loans, or your what are called portfolio loans. A portfolio loan is a loan that's issued by a bank, somebody who has money, who has a line of credit, and can issue and approve that loan on their own terms because they're not going to then sell it later on into a mortgage pool via what are called mortgage-backed securities. They're going to keep that loan in their own bank portfolio. If it goes bad, they lose it. If it doesn't go bad, they keep earning money off of that. So some banks, not some banks, but most banks offer their own portfolio loans for investors, and those will be different terms. You may have one discount point, maybe up to two, but sometimes you may not you have only half a discount point in order to get the rate. And your interest rates will typically be under 10%. They'll be in the single digit range on an investor loan based on today's rates. Your third category, which is kind of the split between them, your private money loan and then your conventional / bank portfolio loans, is what is referred to in our industry as what's called a non-QM loan, a non-qualified mortgage. A non-qualified mortgage just simply means a mortgage that does not have to meet the guidelines that Fannie Mae or Freddie Mac, FHA or VA have set up as what are called agency guidelines. In other words, they don't have to meet these government regulated guidelines. So that's what's called a non-QM loan. One of the things that fits in that sweet spot for those investor loans for non-QM is what are called bank statement loans. A bank statement loan means you're not proving your personal income, but you're showing cash flow through your bank statements to show that you have the ability to be able to make that payment back. That's for people who typically might be self-employed or they have they're seasonal employees of some sort, and so they're not maintaining regular ongoing monthly income, or they're taking tax deductions in order to minimize their tax liability, but they have cash flow. So that's what's called a bank statement loan. That's what's called a non-QM loan that fits into that category, and that can be used for investors. Another type is what's called a DSCR loan. DSCR, that stands for Debt Service Coverage Ratio. DSCR. Debt service coverage ratio. And here's real quickly how that works. If you have a $3,000 a month rent and you have $3,000 a month or less housing expense for that home, then you're approved. So as long as your monthly rent is equal to or greater than what the actual housing expense, then that works on investor loans. Now let me explain housing expense real quick. Your housing expense includes your mortgage payment, so whatever the principal and interest payment is to pay back that loan based on the money you borrowed. It includes your property taxes, so whatever the annual property taxes are for the house divided by 12 for the 12 months. So it's your property taxes. It includes your homeowners insurance. If there are any HOA dues, homeowners association dues, it includes that. So typically those four things are going to be part of your housing expense. Usually you're not going to see mortgage insurance on a DSCR loan because you're usually putting down a little bit more than 20%. So those are your housing expenses: mortgage, principal and interest, property taxes, homeowners insurance, and HOA dues. And if all four of those added together are equal to or less than what your actual rental agreement is, then you're approved. And when I say you're approved, of course you still have to go through due diligence, credit report and stuff, but what's not really looked at is what are your W-2s, what are your 1099s, what are your tax returns, what are your pay stubs. Those things aren't looked at. They're looked at primarily at what is the cash flow? Is it a positive cash flow loan? And do you have positive cash flow transaction, and do you have assets in case you have a vacancy or in case, the tenant decides not to pay rent for whatever reason, in case we have a, government shutdown again, and we're like, hey, you don't have to pay rent for a year, They just want to make sure that you still have assets there to cover that expense. So
yeah. And for the investors out there listening, I've gotten, as a self-employed, multiple business owner type person, with multiple properties. It was 2021. Last year I had closed 4 refinances for conventional Fannie Mae, Freddie Mac loans. And I got to tell you, it was the worst experience of my life probably 9 months. It wasn't the worst experience of my life, but admin wise, submitting paperwork. I mean, it was an unbearable amount, and I felt so bad for the lender that was working with me because it was 9 months of just sending updated bank statements, and they couldn't get to it. And then the underwriter knew that my file took 4 hours to go through, so she wouldn't get to it because 2021 was very busy and there were a lot of loans to close. And eventually they did it. It took a long time. And then I got another loan, a non-QM loan. It was lightning fast. And I don't think I'll ever go back to doing a conventional loan again. Just because of the type of person that I am with my business and the way I do my taxes. And even though I qualify for a conventional loan, it's not all it's cracked up to be sometimes when you're an investor. Trying to prove that you qualify. I don't know if this makes sense to you, Mark, but just the headache savings is sometimes worth paying a little bit extra on the interest, just to get it done and over with and move on to the next deal.
Yeah, you know what brought to mind, Nick, when you describe that experience is I think of that movie Animal House where the guys are in the fraternity rush party and the guy's bent over. Thank you, sir. May I have another? Whap! Slaps him with the board on the behind. Says, thank you, sir. May I have another? Whap! You know, it probably feels like that when you go through that. But you brought up a really, really important point that a lot of people aren't aware of that happens in our industry. Is just the same way that we as loan officers and loan originators are compensated based upon the volume of business that we bring in, so are underwriters. They're measured on how many files they underwrite and they approve and they fund. Some of them are just metrics because every month a metric is listed and they're reported within their own departments and divisions, you know, with their own management on how many they underwrote. And some of them have bonuses tied to how many they fund. So like you mentioned, if you've got a file, if an underwriter has a file that says this one's going to take 4 hours because of all the complexities associated with it, and this one's going to take 1 hour because it doesn't have the complexities, I'd rather do 4 of these 1 hour ones than one of these 4 hour ones. So that's why it's so, yep. That's why it's so critical to know what you're dealing with. And this is where I think a lot of loan officers who are somewhat new in the business or maybe just haven't learned yet miss this, is that part of their job is to make sure this file is as clean as possible so it gets through the whole processing and underwriting process as fast and smooth as possible. What most younger loan officers do is they're so excited and so eager to have a deal, they just throw stuff on the wall. They just throw something in, and then they're like, I need this paycheck. How's it, you know? And they don't do any of the preliminary work. We should be the first ones that say, this isn't going to work, you know, this is why, you know, rather than, yeah, I'll make it work. We'll figure it out. We should be upfront and say, this isn't going to work and this is why. A, or B, say, you got a lot of hair on your file. I'm telling you, you got a lot of hair on your file. And so we can make it work, but you got to have a high pain tolerance. And I'm going to have this conversation right now because I'm going to remind you of this conversation 3 more times in the process. Remember I said you got to have a high pain tolerance. If you're willing to do it, we're willing to do it. But don't expose yourself in a position where, oh, here's my 30-day escrow, or here's I need a short escrow, or whatever it might be. You got to look at you have to be able to set the right expectations for all people so that they're not disappointed. I'm a believer when we enter escrow, guess what? There's no more buyer-seller side of the table. We're all at the same table now together because we all have the same goal. We want to be able to bring this transaction across the finish line. The seller wants to sell their house. The buyer wants to buy their house. And the realtors, the escrow people, the title and escrow people, the appraisers, the home inspectors, the lenders, everybody wants this transaction to go through. So you have to be in lockstep with one another.
Now, Mark.
Yeah.
I'm going to stop you right there because you've got 90% of it accurate, but I will say that appraisers don't necessarily care if the deal goes through or not.
True. That's good. Good point. Yeah. I think I did throw appraisers into the mix. I'll take that one back.
But no, you got such a good point. Sometimes buyers and sellers feel like these people aren't on their side, or like somebody's trying to kill the deal, and it's not true. Everybody wants the deal to go through because otherwise nobody gets paid, except for the appraiser. So continue. Sorry I interrupted you.
Yeah. So, anyways, my point there is that we're all on the same table. We should have open and honest communication with everybody. As soon as there's any bad news, you've got to be able to communicate that. You got to communicate, hey, we have an issue here. This is what it is. This is why. This is what we're doing about it. I need 48 hours or whatever the case may be. Because I think it's fair that everybody has skin in the game once we open escrow. And so since we all have skin in the game, everybody should know what the plays are we're calling. We're not playing offense and defense. We're on the same offense together. I can't expect to call a play, with my running back and not let the lineman know which direction he's going to go. I got to let him know which direction to go. So you got to block for that. And so likewise, the team needs to be communicated on, hey, here's the latest update. And likewise, if you're the recipient of the bad news, but you have a plan, you can't freak out. You gotta trust the system. You gotta trust the people that you're working with. And if they've let you down, you can't trust them, then find somebody else. Find somebody else to help you along the process. But when you are all on the same page, that's why one of the things I have here, I happen to have one right here. One of the things here, this is an example, new escrow checklist. Okay, here's an example. We just opened up escrow on a transaction. All these things we ask. Hey, I call the listing agent, the representing the seller. Hey, this is Mark Martinez with Waterstone Mortgage. Congratulations, we just opened up escrow on 5365 East Volterra Drive. I'm working with the buyers. Great to meet you. You have an initial conversation. Hey, one of the things we do just to make sure we're on the same page is I go through this checklist just to be sure that we're not missing anything. So can I just take a few minutes? Confirming the sales price, any seller paid closing costs, close of escrow date. Is this a domino sale? If it's a domino sale, are we using the same title company? What's our confirming the loan contingency date, appraisal date? Is this a divorce situation? Is the home held in a trust? Confirming the escrow company they contact, confirming the property type. Is this a 90-day flip? Are there HOA dues? And if so, this is the amount that they are. Is the home currently vacant? If so, are the utilities turned on? Are there any appraisal concerns? Any planned repairs? Are your CO2 detectors installed? Any unpermitted square footage? And then here's the key one. Are there any planned vacations either you or the seller are planning on taking before you close escrow?
That is key. Yeah.
Mark, I cannot believe I don't use you enough. I've never had a lender actually walk me through a checklist like that, but it is the simplest and smartest thing I think you can possibly do as a lender is to ask these questions before you just stumble upon each scenario. So kudos to you. I've got to start sending you more business, and I apologize.
just don't send me your 9-month files, okay?
Yeah. Well, you get what you pay for, Mark.
You get what you pay for.
If you're gonna get some, you got to get them all, I guess. So,
I was kidding.
All right, so we're at the hour mark here, by the way. We're gonna start kind of winding down the show. I got a couple extra questions for you, Nick, unless you wanted to add anything before I kind of go into the final wind down.
No, it's Monday morning. Let's get Mark back to work.
Yeah, we all got stuff to do, but Mark, this has been really great. First of all, you provide a lot of value and a lot of insight into what mortgage lending is. Again, I'm just going to ask a couple questions to kind of wind down the show. So the first is, if you had a business or investing book that you recommend any investors or people looking to get into this scene, what would that book be?
Well, I actually have 2 copies of it, and it's one that you guys often offer at your meetings. Is the Millionaire Real Estate Investor
by Gary Keller.
I mean, there's so much content in there, and it guides everybody through the process. It has checklists, it has charts, it has financial not calculators, but the calculations, how to do this stuff. It's a great primer on exactly what a real estate investor should do. So that is the first book that came to mind. I actually have, and in fact, I've had several copies I've given away to people over the years as myself.
Yeah, it's a good book for sure. I just recently read that within the last year, so glad to finally be on that bandwagon, and it was a cool book. So
It's about time.
Yep. The next question I have for you, Mark, is what we call the $30 million question. So if $30 million was just gifted into your bank account, what was the first thing you would spend it on?
I don't think you want to know.
Okay, what's the second thing we'd spend it on?
No, I'll tell you. No, I'm just kidding. No, so the assumption is the $30 million is for me to use according to my discretion.
Whatever you want. Do you want to buy an asset? Do you want to buy a liability? Do you want to take a big vacation? Like, what's the first thing your impulse buy would do, basically?
So I would use all of that money, all of it, in order to be able to take this teen mentorship program that I developed and take it worldwide. So there's a difference between what I call a career and a calling. Your calling could be your career. For some people it is. But your calling is what you're paid, your career is what you're paid to do, but your calling is what you're made to do. Your career is where you earn your compensation, but your calling is where you've earned your inspiration. And I think a lot of people go through life never really wondering, why am I on this earth? What's the purpose of life? What am I doing? Am I offering any value? Am I contributing? Am I making this world a better place than when I arrived? And I think a lot of people struggle with that. And I think that's a critical question that every one of us should be asking ourselves until we figured it out. Well, I figured it out. And what I did is I developed a parent-led teen mentorship program for families that have 12 to 14-year-olds. And the reason why that age is that's when everything changes in a young person's life. I don't need to convince you guys because it happened to you too. When you guys are 12 or 14, everything changed in your life, right?
That was a time, yes.
That was a time, exactly. And so I think we're not preparing our kids well enough to what takes place and how to navigate that through that process in time. So I wrote a program and a curriculum that helps parents together with one another and teens together with one another in a group to say, hey, this stuff is coming your way, whether or not you're looking for it, it's gonna come looking for you. Here's what a good decision looks like. Here's how to make a good decision, and here's how to stay away from making a poor decision. And if you do go off the rails, here's how to get back on. Because you're in the most vulnerable portion of your life, and we would rather surround you with our own knowledge and our experience and mentorship so that you have the best opportunity to lead a successful and a fruitful and abundant life and not be derailed like we see so many of our young people today in this country. So that's where I put all the money into that.
Mark, that's great. That's a really cool program you have, by the way. I love everything I've seen. Is it the crop program, right? Okay. At the end of the show, we'll ask where people can get a hold of that and where people can find more information as well. But I think that's really great. Like you've got all these things you're building up, and they're really cool things for sure. So
sorry, none of that money went into real estate. It would all go into yeah.
That's what's fascinating about that question, because everybody has one thing that they would do with it. Right? And it doesn't have to be the same thing. In fact, that's why we ask it, because it's never the same thing. So, kind of cool. The next question we have is, if anybody's looking to get into real estate investing or just looking to buy their first property, what advice would you give them?
So the first thing I would do is have them start educating themselves a little bit, or if not a little bit, a lot of bit, reading the books. You've got great podcasts, great YouTube channel, both you guys do. That has information on there, and then talk to somebody like a lender, because unless you're bringing cash into a transaction, believe it or not, a third of the homes in the U.S. that are purchased with cash. So 2/3 of the homes need a loan. So talk to a lender, but you don't have to limit yourself to one, because what happens is a lender's results may not necessarily be the same with another lender. And here's what I mean by that. I can't tell you how many times in my career I've had somebody come to me and say, oh, we talked to so-and-so and they said we're not ready, or I'm 9 months away, or I can't get it approved, and I don't know why. Nobody ever tells me why. Well, let me take a look, and then I take a look at the situation like, I can do this, and here's why. So if you talk to a lender and they say no, or they say not now, or well, yeah, you got problems, but whatever the case may be, then find another one. Just ask around. Who would you recommend? Who should I talk to that can help guide me through this process? Because first-time home buyers particularly need extra TLC, and so a lot of lenders they're just trying to churn through as many deals as possible, and they don't give the people the time and the attention and the knowledge that they need. So talk to as many as you need to until you find one that says, "Yep, that's the one. That's the one that I want to work with." They're helping me. They're guiding me, just like you guys do, right? You give first, right? So when you find somebody that helps you and guides you and gives you the time and attention that you need, then work with that one.
That's good stuff. Yeah, Nick, anything you want to add to that?
Yeah, no, I appreciate your time, Mark. I have one more question before we go, and it has to do with the state of the market. And I would love, I was on that webinar too, and I appreciate you sending me the link to it. It was a great webinar, and unfortunately, halfway through it, I got blown up with distractions and people coming to the office, and I missed the other half. So I'm curious to get your opinion, and I'm not going to hold you to this. Nobody's going to hold you to this. What's your crystal ball say for 2023 when it comes to the market as a whole in our area, and then the lending business? Do you anticipate growth or destruction?
Yeah, so it's kind of funny because I love the term crystal ball, because crystal ball oftentimes is like, I'm just guessing. What do the spirits say?
And
that
that's what
type of thing.
we're just guessing.
Oh yeah, that's all opinion. So
Yeah, but I like to go more on data and facts. And the data and the facts, we have history, we have current trends, and we have future projections. And I'm going to summarize it here, and I can back it up with the data and the facts. I think we're going to see interest rates drop. By the second quarter of this next year, interest rates will drop down from where they are right now to probably just under 5%, low 5%, if not upper, just under 5%. So that's going to move the needle. People that got to the sidelines because they got freaked out by 6 and 7% rates, they're going to come back. That's the first thing that's going to happen. Second thing that's going to happen is we're going to have a real housing crisis still. And when I say crisis, we are going to have a shortage of homes that are available, and that's going to continue to push home prices higher and higher and higher. So that's why I'm a believer, man, you got to get a house as fast as you can. If you're renting, buy one as fast as you can. And if you are able to invest, get as many homes as you can. So I'm gonna circle back around and touch on real quickly why it looks like interest rates have come down. It's tied to inflation. It's not tied to the Federal Reserve. It's tied to inflation. Interest rates always stay within about 2% of whatever the within what's called the 10-year Treasury, and that's geared and promoted most by inflation. And so when we track the inflation trends, we see that probably, like I said, by Q2 we'll see interest rates coming back down. The second thing is that's going to attribute in terms of the housing situation is I think we're going to have a housing shortage based upon two things: the number of homes that are being built and the number of homes, new homes that are being created. And when I say created, new homes are created in terms of new households created. And here's what I mean by that. On average, a person grows up, lives with their mom or dad, and then they move out and they buy their own home. And on average, it's about the age 33. 33 years old is the average age when somebody buys a home. I was 30 years old when I bought my first house. And so when we look at the birth trends from the Gen X, from the baby boomers, Gen X, the millennials, and the post-millennials, we had a significant drop in birth rates starting in 1973, 74, 75, 76, 77, 78, 79. Those years, we had a big drop in birth rates. And so if you forecast 33 years in advance from 1973, where are we at? 2006, 2007, 2008, 2009, right? Our housing crisis, right? That was our bubble. We had way too many houses. We had 4 million homes in inventory during that time period, and we didn't have enough of the population because we had a population drop. Now, today, we have only about 1.2 million homes in inventory, of which about 423,000 of those are currently under contract. So that means just over 750,000 of homes are available in inventory that we have right now nationwide. And guess what? We have 30 million more people today in this country than we had back in 1973. And so the forecast is rates are going to come down, but housing prices are going to continue to rise. Anybody who believes that we're on a housing bubble and it's going to burst, I'm telling you, are wrong. But guess what? You're hearing that from your mainstream media, your news reports, because guess what the job is from the mainstream media and news? Is to sell bad news. That's what sells, is bad news. So do not look at your news reports and oh, foreclosures are up. Foreclosures are up 50%. Oh, you mean year over year? Oh, you mean like from a year ago when you couldn't foreclose on a home because the government said no foreclosures are allowed during the pandemic? Oh yeah, of course they're going to be up, but the needle was moved like from this to that. So you can't follow those news reports. Follow the statistics, follow the facts, because the trends will always tell the story. So long answer to your short question, what's going to happen with the housing market in 2023? Rates are going to come down, home prices are going to go up. You got to buy as many houses as you can right now.
That's good. Thank you for backing it up with facts. Yeah, I just think and I also think it's amazing because I work in an industry in this area with a lot of newer real estate agents. Like, seems like the majority of them got into the business within the last 5 years, and they don't know what a normal market looks like, and they all think that the market's crashing right now. And our inventory levels are showing us it's a seller's market. We're at 3 months ish, and it's
it feels more like a market stabilization for sure than more like a market crash.
And if I can pitch this, I'm not gonna ask you permission. I'm gonna pitch it anyways.
Do it.
I do have a private realtors only Facebook group. So if for realtors only, they can join my Facebook group, and this is where I post a lot of this data. This is where I put the link for the webinar that you were on that you missed half of it. It's up there. This is where I post the charts and the data, the trends, inflation, forecasts from Mortgage Bankers Association, from CoreLogic, from National Association of Realtors, from Fannie Mae, Freddie Mac, all this data, Case Shiller, all the analysts who track all this stuff. I'm constantly posting charts, graphs, stuff that any realtor should have anytime they're going to talk to a potential home seller or home buyer. They need to be equipped with the facts so that they're presented as the expert. They're not, the consumer's not swayed. The consumer is swayed by the reports they hear on the media, because of course it's always bad news. Yeah, but here's the data. Here's the facts. That's how you set yourself apart as a real estate agent.
What's the name of that group?
I just call it Realtors. It's just called Realtors.
Okay.
And it's under my name. So they have to friend me first. And once they friend me first, then I can send them an invite. So yeah, I just call it Realtors. So it's kind of nondescript, and it just says, if you go to it, you show it's the picture of one hand holding a mini house, another hand holding keys to the house, and it just says Group by Mark Martinez. And so,
speaking of that though, Mark, where's other places people can find out about you?
First of all, my website, markmartinez1.com. It's just my name followed by the number 1, not O-N-E, markmartinez1.com. That's where you can find out my mortgage stuff. And for anybody who wants to find out about the teen mentorship program, that's called cropministries.org. C-R-O-P, ministries, plural.org.
Cool. And we'll put that all in the show notes too when we put that up. So
awesome. Thanks.
All right. Thank you so much, Mark. I appreciate you being here.
You're welcome. Thank you.
And thanks everybody for tuning in. We'll see you on the next one.
Thank you so much for checking out the Investor Shed podcast. If you enjoyed your time, make sure to leave a 5-star rating and review on Apple Podcasts and Spotify. Follow along on YouTube, TikTok, and Instagram at The Investor Shed for shorts and promos about each episode. Do you want to be a guest or know someone who has great real estate investing advice and stories? Reach out to us at theinvestorshed@gmail.com.